My money will multiply very soon, and I will become richer. Watching mutual fund advertisements in media makes everyone believe that the best thing to do in life is to put money in funds. Stories of fantastic returns given by funds in past is ad nauseum repeated by your wealth advisors. However, the actual outcome once you invest may be quite different, if not disappointing. I have seen many investors losing money also since they did not know the basics of mutual fund investments. If you want to minimize your risk of losing money in mutual funds, watch this video till the end. These 6 facts will help you become a better investor. Hello smart people. Welcome to Smart Money channel, which helps you with smart facts about managing money. If you like the video, please subscribe by clicking on bell icon below. So, without further ado, let's jump right into it. Remember, this is not an investment advice, but just an educational video. Do your own research before investing. Fact 1. No fund is risk-free. As fund manager invests your money in securities or stocks which are traded in market, they carry the associated risk of market fluctuations. If market goes up, returns are likely to be better, and if market goes down, you may even get a negative return. We all are aware of the risk associated with stock market, which makes investing in equity funds risky. However, even bond funds or income funds can generate negative returns as bond prices also fluctuate on daily basis. Though fluctuation in the bond funds may be lower than the fluctuations in equity funds. Keep this fact in mind. Now, how to minimize this risk? First of all, you need to determine what is the time horizon of your investment and how much risk you can tolerate. If your time horizon is 3 years or more and you are okay with some degree of fluctuations, then only invest in equity funds. Any time horizon shorter than 3 years exposes you to a greater risk of fluctuations or even losing capital and getting a negative return. Longer the time horizon, lesser the probability of loss, based on historical data. For a time period between 1 year to 3 years, you may evaluate bond funds or income funds. And for shorter than 1 year period, liquid funds or short-term funds may be a good option. Fact 2. Fund managers will have their own biases and models. Your money is managed by a fund manager, who decides where to invest basis his or her research and understanding of market. Good fund houses will have very robust investment guidelines, which fund managers have to follow. Still, they have the flexibility to make decisions within those guidelines. This exposes one to the biases of the fund manager and his or her investment model. To minimize the fund manager risk, do a bit of research on the funds managed by this fund manager. Check how these funds have performed in past vis-a-vis market benchmark. This will give you a fair bit of idea if this manager is good or not. Another way is to invest in index funds, which tries to mirror the benchmark indices of the country, like S&P 500 in US or Nifty in India. Index funds reduces the biases of the fund manager to a great extent as fund managers can only invest in index stocks in similar proportion. Fact 3. Mutual funds have a cost of fund management, which comes out of your investment corpus only. It is only fair that fund managers charge you a fee for giving you the investment service that they do. For an individual investor, mutual fund is a great vehicle as it is not practical for everyone to research the market and manage investments like fund managers do for you. However, be cognizant of the fact that there are loads and charges in your fund, such as entry load, exit load, fund management fee, etc. With a bit of research and awareness, you can reduce these costs. For example, funds offer direct plan where investors directly invest in funds instead of going through an intermediary like an agent or a bank. As there are no intermediaries, funds charge lesser cost. So better to go with direct plan if you understand which funds to invest in. Intermediaries are experts who help and guide you in choosing the right investments. They also provide you with the service of facilitating investments, tracking it, and helping in redemption when required. So, you will have to evaluate your own capabilities before deciding if you want to go for a direct plan to reduce cost. Other option is again to go for index funds as they generally have lower fund management fee as the expertise of a fund manager is not required or required in a limited sense only. Fact 4. It doesn't matter if you are buying a fund at a net asset value of 10 or 100. Fund houses advertise heavily when they launch a new fund scheme. Your advisors may make you believe that it is a good idea to invest in a new scheme as you will get at a face value of 10, against an established fund scheme where the NAV may have reached, for example, 100. This is nothing but a marketing gimmick. Do not fall for it. If the new fund scheme is offering you a benefit which existing funds do not offer, then only go for it. For example, new fund may have chosen to invest in a niche or sector which existing funds may not have done. Then only it makes sense to go for a new fund scheme. Else prefer a time-tested established scheme. You may ask, how 10 and 100 may be same? The answer is, NAV of a fund is a function of the market price of the stocks or bonds they have invested in. So, if a new fund at 10 invests in the same stocks in same proportion as an old fund whose NAV is 100, theoretically they both will give similar returns. Fact 5. Do not try to time the market. Markets may fluctuate every day. Buying and selling funds like individual stocks are not advisable. It is cost and tax inefficient, both. The best way to invest in mutual fund is to have a plan, that is time horizon, risk appetite, liquidity requirement, etc., and invest accordingly. Stick to your plan. Evaluate your portfolio once every quarter, and if at all any changes are to be made, try to do maybe once in a year. Systematic investment plans, or SIPs as they are popularly known, are the best way to invest in mutual funds, as they take out your own biases and they kind of neutralize the market fluctuations by averaging your purchase price. Fact 6. Historical returns will not be repeated in future. Almost it never happens that the same scheme delivers the best returns quarter after quarter. Many investors have this strategy of investing in the fund schemes which have given the highest return in past. This is most fundamental and common mistake many investors make. Always choose funds basis your own goal, risk profile, time horizon, and performance of fund house and fund manager. Seek professional advice if you want. Do some research. There are many neutral websites which rank funds basis these factors. Choose your investments wisely. Do not only look at the historical returns. These facts are important not only for beginners but for anyone looking to invest in mutual funds. Hope you have been able to understand the above 6 facts. Watch it again for better clarity. If you manage the above 6 facts, you will be able to manage your mutual fund investments in a much more informed fashion. Minimize your losses and increase the probability of a higher return by following the above 5 advice. Do not forget to watch our other videos on investments on our channel. Do like and subscribe the channel and share with your friends. Happy investing!